Hey guys, my name's Max Convexity. Welcome back to the channel. I really appreciate you guys being here. I have a good one for you today. We're going to look at the new Kurv fund, KQQQ. KQQQ. It's probably better than the ticker symbol than they maybe could have chosen, right? All right. So let's do like a quick preview. This thing started trading yesterday. Well, I had the pleasure of interviewing Howard Chan, who from Kurv Investments. It's his company. He's the founder and CEO. He was on the channel and he was teasing this fund at the time, and he kept trying to tell me that it was something that hadn't been done before, but he couldn't really get into it. Well, anyway, I think I know what he's getting at now. This is a pretty interesting deal. It's basically a better mousetrap is kind of the way I'm looking at it right now, or Howard's trying to build a better mousetrap. It's only 2 days old. We'll see if he can execute it. But as far as the plan goes, I like the plan. So let's talk about management fee. 79 bips, which is competitive. That I think that's fine. We'll see how they do. There was not any rumors that I could find prior to this coming out. They did a really good job keeping a lid on the rumors. All right, so let's review some of the promotional material here. So let's start with this literature right here. So it's called the Technology Titan Select ETF. It doesn't mention yield or income in the name. So it says the Technology Titan Select ETF seeks to maximize total return by actively managing a portfolio with concentrated exposure to high conviction technology titans, while at the same time generating potentially tax efficient income. The largest technology companies continue to be the growth engine of the economy. If we use the top 100 companies listed in the NASDAQ exchange as a proxy, the top 15 companies have outperformed the bottom 85 out of that top 100 significantly. All right, so how does this strategy work? Well, first I want to show you one thing. Let's look at this. Here's the prospectus. Prospectus is kind of boring. We're just going to look at the promotional material. I've read the prospectus, but the most interesting thing is, or I just wanted to show you guys this so you believe it with your own eyes. Investment objective: the Kurv Technology Titan Select ETF seeks to maintain total return consistent with prudent investment management. Nothing about income, nothing about yield, but yet this is a covered call fund. So, but it's more of a total return fund. This may have finally bridged the gap. This may be what growth investors have been looking for, who need income but are unwilling to sacrifice growth. It looks to me like Howard and the guys are trying to make a fund that grows as faster than other funds, but can still bring in the same income. Anyway, I'm going to tell you how he does it. It is an interesting idea, and it hasn't been done yet. So we're going to start following this one a bunch. Okay, so smart security selection. So what they do is they remove the non-technology companies to help gain pure exposure to the top growth stocks. They can use physical shares or synthetic, which is where they create shares with an option position, or they create the exposure that shares would have, but they do it with options. All right. So then what they're going to do is, once they knock out all the non-tech companies and they choose the 15 biggest tech companies, then they're going to momentum weight those 15. So the ones that are on fire are going to be weighted the highest. So this year, I'm sure they would have had NVIDIA weighted the highest, or 6 months ago when it was the hottest. Right now, it's probably something else. It's cooled off, but right now it's something in the Russell. It's right now it's Mr. probably or something. All right. Potential downside mitigation with income. This is the part I'm interested in. And this is the interesting part to me. So writing covered calls seeks to generate income on stock with limited upside potential or low price momentum. Wait, so I have to read that again. Writing covered calls seeks to generate income on a stock with limited upside potential or low price momentum. So did you hear that? They're going to write covered calls, but they aren't going to write covered calls on their 15 stocks they're waiting with momentum. Those are going to be long. They're going to choose some dog shit stocks to write covered calls on, is the way I take it. It didn't say the words dog shit in the prospectus, but they're going to choose stocks out of the universe of NASDAQ. They don't really say exactly how they're going to do it, but they're going to choose stocks that have low momentum and then write the calls on those. It's a great idea. I bet they get less premium that way, but I'm sure they've considered that. So potential portfolio application. So this is how it could be used to gain exposure to tech companies that are likely to benefit from advancements in AI. To generate income. Income generation could serve as a potential downside mitigation. Also aims to maximize total return on growth stocks. So this is very interesting to me. So let's look a little bit deeper. Let's read this right here. This is kind of like their white paper. Okay. The Kurv Technology Titan Select ETF seeks to maximize total return by actively managing a portfolio with concentrated exposure to high conviction technology titans, while at the same time generating potentially tax efficient income. Why focus on large technology companies? The largest technology companies continue to be the growth engine of the economy. Their size allows certain market dominance and pricing advantages globally. Continuous development of artificial intelligence in forms like large language models require large amounts of training data and even larger amounts of computational power. These titans seem to be well positioned for the future as well. If we use the largest 100 companies listed on the NASDAQ exchange as a proxy, there are issues with this as well, we will discuss later. We find the 15 largest companies have outperformed the smallest 85 within that group of 100 significantly. All right, so here's some past performance. So look at this. In 2019, the top 15 outperformed, but not by very much. 2020, the top 15 was up 53%. The rest of the NASDAQ was up 50%, though. Gosh, that was a face ripper. Look at this. The top 15 were up 34% in 2021. NASDAQ only up 30. But then here's the downside of this. When you do momentum weighting, if you have a down year, you're gonna lose more than the index. And that's what happened in 2022. They actually outperformed the index on the downside. But look at 2023. They performed about 20% better than the NASDAQ. And they aren't writing calls on any part of that portfolio. If they had been doing this in 2023, in theory, they would have been up 69%, because that's how much that part of the portfolio would have been up. Then they would have generated income on some, like I say, dog shit stocks, some lesser, some stocks with less momentum or whatever I know they have a quantitative model that models all this out. So you would have to figure they would be up in 2023, they would be up right around 70%, plus whatever the covered call strategy brought in. And that actually may have been a drag on the portfolio too. You never know. As you know, when covered calls, sometimes you get stuck with a stock that goes down and it causes your NAV to come down. So, but assuming they could have at least just broke even on the covered call portion of the portfolio, that would have been a covered call fund that was up 70% on the year. That's just unheard of. That's the way this fund is designed. They're designing this fund to have those types of abilities. So, we shall see. Talk is cheap. Anyway, here just kind of consolidates the white paper over the last 15 years. It shows you the edge. It's not a huge edge. It's about 5% right there. In the last 10 years, it's closer to 10%. So interesting. Okay, so here's what I was just kind of telling you guys, but let's just read the white paper. I was kind of getting ahead of it. Does the higher return come at the expense of greater risk in the basket? The return of the top 15 companies does come at a slightly higher volatility. That's what I was saying when I said, well, if a down year comes, a bearish year, these are going to outperform on the downside. And that's what happens when you have a higher volatility and a higher Sharpe ratio. This means for every unit of risk, the basket of the largest companies typically generates higher returns than either the entire index or the bottom 85 companies. Additionally, the top 15 companies fare better in the worst monthly performance and drawdown categories. And of course, so their worst months aren't as bad as the worst months for the rest of the group. So that's good. So the reason is the distribution of returns for the biggest 15 names tends to skew higher than the returns of the overall index. Although counterintuitive, our analysis shows that concentrated exposure to high conviction technology titans can improve overall risk-adjusted returns. The exposure can be used not only as a component, but also as a substitute for existing technology allocations in the portfolio. All right, so then it says, how do you actively manage the ETF? Kurv leverages our systematic three-step portfolio construction process to maximize total return. Step one is the smart security selection. So that's where they narrow down to the 15 tech stocks. Step two is the momentum weighting. The ones they have an algorithm do this, but they weight it based on momentum. Okay, then step three is the downside mitigation with the income generation. So that's where they choose the stocks with the less potential for upside, and they write calls on those stocks. It's a great idea. I can't believe I haven't thought of that. I've thought of a lot of ideas, but I haven't thought of this one. I've thought of other ideas to still get the income and not have downside, but not this one. This is a good one. Okay. So step one, they're just kind of going over this again, smart security selection. It's going to say the same thing. I've probably already read you a couple times about the pure, they're seeking to get a pure, what do they call it? Pure exposure, or a pure high conviction portfolio of large tech companies. And then they do say that they do the selection process once a quarter. So you're stuck with the stock for a quarter. Then at the end of the quarter, they can put a different one in. Now, I don't know how often they change the weighting. I think they change, but I think it's once a month, though. They reweight it monthly, but we'll keep reading. Okay, new technology companies tend to have slower growth profile than the technology counterparts. Non-technology companies tend to have slower growth. Yeah, we've already talked about that. And they tend to be laggards. The filtering process has historically led to significant improvement in portfolio returns. I wonder if they're just using the group they don't really say how they choose the group to write the calls on. I wonder if they're just using the bottom 85 or maybe just the non-tech. Maybe they're just using the top 15 non-tech. You see right here, it says top 15 non-tech. And look, 5-year return is about half of the other one. So you could write calls on those. And yeah, you're capping the upside on this portion of your portfolio, which isn't that good anyway, because you're over here fully uncapped, making 70% in a good year, right? This is an exciting strategy. This reminds me it doesn't remind me of it, but there's other funds that have a lot of horsepower, and I'm thinking of Bally and GPIQ. And what they do is they use futures, and they get a little bit of leverage, and they're kind of like a high power fund, a high power, high yield fund. This reminds me of that fund, but these guys do it in a smarter way, because these guys, I don't believe they're not doing it through leverage. They're doing it through concentration, which simulates leverage. It's a really great idea. The more I think about it, the more I like it. Okay, momentum weighting to magnify returns from tech outperformers. We've talked about that. Let's see what it says. It says many technology or growth companies tend to have price momentum. This means that if the price of the tech stock is rising, there's a tendency for the price to continue to rise. This is the old reflexivity argument. They even said in the prospectus or somewhere I was reading, I think before I started this video, although it's counterintuitive to weight the top momentum stocks the heaviest, because you're just kind of assuming what has been working will continue to work, at least through that quarter. And while that's counterintuitive, the testing bears out that's been working. And I think that's something in the market called reflexivity, or I call it a feedback loop. But and something we've had, especially ever since quantitative easing started. So that's another story, and that's another video. But anyway, this fund's going to be fire. Okay, so now let's talk about the written calls, momentum weighting. Okay, we already talked about that, but now I want to see how are they choosing the stocks to sell calls on. As you guys know, that's what I'm interested in. So it says, using our momentum factor, we look to overweight technology names that demonstrated consistent price appreciation while underweighting those that have moved sideways or fallen. By overweighting momentum stocks early in their price trend, we aim to capture additional returns through capital allocation. All right, step 3, writing cover calls to generate potentially tax-advantaged income and to mitigate downside. Another quality of growth tech stocks is that they typically distribute no or very low dividends. Income or dividend investors have had to contort their equity exposure by underweighting technology sectors, the growth engine of the economy, and overweighting legacy or slow growth sectors like banks or utilities or energies in order to get a yield, right? That's how you had to do it in the old days. So no, you don't have to do that anymore. To lessen this trade-off, this ETF looks to write cover calls on low or no momentum tech stocks to generate income. The premium received from the written call can be distributed as income. We believe this is a great complement to step 2, as call options written on low momentum stocks have a higher probability of expiring out of the money, hence fully harvesting the premium received from the call writing. So the idea is you're fully harvesting the premium and you're doing all that, right? And then your top 15 stocks don't have any calls written on them, and they're just blowing up, ripping people's face off every day, right? I mean, that's the idea, because they're unencumbered. The growth portion's unencumbered. This ETF is more of a all-weather strategy, or the other ones are strategies too. The other ones are more like systems. Triple QI is like a collection system. This is more of, to me, a little bit more of a fully fleshed out campaign, maybe a campaign type strategy. All right. Well, let's pick up where we left off. They just talk some more about cover calls. I think you guys know enough about those already. Anyway, it says, by combining these 3 steps, we believe the ETF can maximize risk-adjusted returns. Well, I'm all about it. I am all about it. Okay, so now let's look at this. It's only been out a couple of days. I have a new buffer sheet. My old buffer report quit working. So I put it on the very top line, KQQQ. Their reference asset, or they don't really have a reference asset or a benchmark because it switches. It's kind of like ULTY. We're just going to use NASDAQ for them. And on ULTY, we use Russell since it's the most volatile. Okay, well, you can see today, KQQQ, I'm going to have to get used to saying that, outperformed its benchmark. It was 113%. Wherever it's green and the lighter the green, the higher the outperformance. And then if it's not green, it was underperformed. So YMAG and ULTY actually underperformed today, but the big outperformers were CLIP, KLIP, JEPY, RYLD look good. Of course, it's based on the Russell. Anyway, all right. Guys, it looks like KQQQ is a ULTY, FEPI, and or possibly YMAX / YMAG killer, possibly. I mean, we'll see how they do. I mean, talk's cheap. I mean, a system like this, if we do hit like a rough spot in the market, you know, and they opened it yesterday and the market keeps pulling back like I've been saying it's going to, and I've been right so far. I've been saying it for 11 days now. I started saying it July 10th. So anyway, or that's when the first time I made a content about it was. And so far I've been, you know, dead right, unfortunately. And I think it's going to keep going. One event, that type of tape action will hurt a fund like this. But having said that, though, every quarter they get to readjust their positions. If say next quarter, if we get into maybe a bear market, I wonder if they could put like defensive tech stocks in there, maybe like Raytheon, defense contractors, some other kind of space tech, or some other kind of tech that's not so based on the consumer economy. You know, in any event, it should be interesting to see how they do this. I'm going to get Howard back on the show. I'm going to start evaluating this show. I'll start covering it. Corey covers ULTY, so I'll make this one my jam. I was going to do ULTY, but Corey's already got that one, so I'll start covering the funds in this one. So let's look and see the stocks in this one. So let's look and see what stocks are in it now. Now their website's jacked up, and it's jacked up yesterday. I was going to do this video yesterday before I came on my trip, but I couldn't get this one thing to work, so I put the video off till today, hoping they would fix the website. Same thing, still not working. Okay, so here's what they show. They show you the top 10 holdings. So last night I couldn't figure out why they didn't have any calls in here. Well, they aren't going to sell calls on these. That's fine. So it looks like this quarter, Google is their top weight, or cash is their top weight. They have 35% in cash, but of the 15, they have their top weight looks like Google at 12%, Amazon at 10%, Apple at 9%, Meta at 6%, NVIDIA 6%, Avgo, which is Broadcom, at 5%, Tesla at 3.92%. Nice job on having a lower weighting on that one because it's getting murdered today. Well, everything got murdered today. AMD 1.6, Oracle 1.6. So that's not all their holdings. So they have download full holdings right here. I can't get it. It will not download. I tried using a different browser. I tried restarting my computer. I haven't tried it on the phone yet. Anyway, if anyone can get that to download, send it to me if you want, or I'll keep trying. But in any event, we'll get on top of what they have. But because I want to see which ones they're selling options on. I'm more interested in that part of it. I could have told you what the top 15 is going to be. It's going to be the same 15 that FEPI uses probably, or a similar type of 15. You could also go with the same stocks YMAX uses. Those may not all be just the greatest stocks, but they're mostly pretty damn good stocks. So, I think it's going to be very similar to those. Now, I said it's potentially going to be a ULTY killer. It's doing the ULTY thing in kind of a different method. ULTY rotates stocks in and out. ULTY rotates them in and out weekly. This is going to rotate stocks in and out quarterly. ULTY rotates stocks in and out based on several things, but mostly I believe they're the amount of volatility, the amount of premium that's available to capture. These guys are doing it a totally different way. They're going to rotate stocks in to sell calls on they don't think are going up, and anyway, and then they'll rotate stocks, in just to buy and hold long that are the good stocks, Apple and Google and all those, the big tech stocks. So like I say, I think this might be a better mousetrap. This gives me all kinds of good ideas for money management and different funds. But this is a whole different way to think about these high yield funds. I bet this fund, they're gonna do monthly calls. So I bet they earn 8 to 12%. I bet this earns about what JEPI does, which is great. I mean, because bonds only earn 5% at the most, 4 or 5%. So you earn 8 or 9%, you're earning double bonds. I mean, and something like this, you're going to have hella upside. I mean, I'm all about it. I'm all about it. This is the first time I've been this excited about a non-defiance product or a non-YMAX product. I mean, I think Crash is a pretty exciting product. I really like Crash. I really like that whole family of products. And I really like Triple QT. This is the most excited I've been about a product since Triple QT. This is going to give Triple QT a good run for its money and probably beat its pants off, honestly. Triple QT is going to pay about twice the dividend, but I bet you the other one, KQQQ, has about twice the capital appreciation. Like I say, we're only 2 days into this, so we'll see. All right, guys, it's been a long day. I've been traveling all day. I'm going to go to bed, but I'm going to wake up in the morning and I'll try to have the morning report on the daily covered caller. I usually put it on right about lunchtime, but I think it should be on around 11 o'clock tomorrow. All right, guys. Well, I appreciate you, and you guys have a wonderful day. All right.